Okay, Jal Irani is now joining us, Senior Vice President of Institutional Equity Research at Edelweiss. Jal, good afternoon. Thanks for joining us. What kind of EPS moves do you see on some of these listed players if indeed we have gas coming under the purview of GST?
So I think if it comes under GST, it's certainly a positive. But I think the markets moved way ahead of itself. The positive is not immediate. The positive is significantly in the longer term, not even in the medium term. I don't see any significant positive margin moves in the near term, in the immediate near term, if this happens. Because firstly, if there is any reduction in cost, that'll be passed on to the consumers in any case. And in fact, there are potentially some cases where there may be a slight increase in cost also, which will also be passed on to consumers. I think the market has completely misread this in the near term. It's essentially because today there is VAT being levied or different taxes being levied across different states, and it is not under the single GST where you get tax credit once you move gas from one border to the other. Therefore, there is multiple taxation, and therefore the gas does not move across borders easily. Now, once it comes under GST, then there will be a seamless moving across borders eventually. And therefore, to that extent, one would be able to source gas from any part of the country, and the volumes will go up dramatically. But for all that to happen, the next step has to happen after GST has been brought in, which is the pipeline network has to be on a nationwide, across the country. So therefore, the next thing which will happen is a pipeline rollout and a national grid, which will take several years. So the bottom line really is that this is, while potential long-term volume kicker, I don't believe that this is going to make a difference to margins in the immediate future in any case. So all good, but it's going to take a while.
Hey, all right, understood that. Jal, afternoon. Any reason why one should expect that at least there'll be some savings? Because the whole idea was that these companies weren't able to claim input tax credit because they were not in the GST chain. So any reason to believe that perhaps there could be some sort of savings? That is if they don't decide to, of course, pass it on to consumers in the form of lower gas prices.
Well, see, eventually once the entire... So let me put it this way, that... let me give you the example of Indraprastha gas, and these are not calculations I have done, but from what the companies narrated to me. Now, the expectation is that GST may be 18%. Now, the taxes put together at the moment are less than 18%. So actually, in the case of Indraprastha gas, the net tax may actually increase on the face of it initially, which they will pass on. But progressively, as the volumes across the countries becomes fungible, then the sourcing of the gas, the cost may actually decrease. So in terms of the taxes, you'll either have a net neutral. So look, they're not putting it under GST to actually change the total tax collection. Okay, oil and gas is by far the largest sector in terms of collecting taxes. So they're not going to change that by any means. So but what they're trying to do is making sure that it is seamless across borders. And therefore, for example, if gas is cheaper from Ennore on the East Coast to ship versus the Dahej from the West Coast, then it becomes easy, then it becomes a lot more fungible, and then the whole cost of the gas eventually comes down. Also, what is happening today is that there is a lot of, the spot cargoes which come in, there is a significant margin which the importing companies such as GAIL get from these spot cargoes. Now, once the gas is fully fungible, then the gas exchange becomes a transparent mechanism over which these spot cargoes are traded, and therefore those margins actually come down, and then again the cost to consumers decrease. So that's when actually the likes of IGL will start benefiting in the longer term, and basically as gas flows across the country, the volumes will increase dramatically. But I'm not too sure if there is actually an immediate, I don't think that there's meant to be an immediate margin change for these companies. Basically, the way ideally it will be brought in is that the new GST will be tax neutral on a holistic basis versus the various taxes today. They don't want to change that today, right? You don't want to change the total tax being charged on day one. But once the volumes increase, taxes will go up, prices will come down due to better sourcing, basically.
Got that point. Finally then, Jal, okay, you said the stocks have run up way too far ahead of themselves, especially Gujarat Gas, has had a big move. But at current levels, is there any stock which is still offering a good risk reward, regardless of this news on fundamentals?
Look, I don't know what you mean by current, because, they were all up 15%. I don't know what they're up now. Frankly, we are very bullish on the city gas space, especially the gas sector as a whole, and we are very bullish the entire city gas space. So I can say in general we are very bullish. But at what point of time the stock price is, right now versus an hour back or 2 hours back, I don't know. So difficult to say.
Okay, since we have you with us, I'll just take the liberty of one out of syllabus question. GAIL is doing a buyback. The stock is up like all PSUs actually. Just your thoughts on this one?
So, clearly a lot of these stocks have got some deep value, and the market for a while has been refusing to recognize this deep value. So I think buyback is a sensible way to actually, rather than invest in new projects which will earn you a reasonable IRR, here you are investing in your own projects and actually at a discount, which is what the stock price, if the stock price has been fairly undervalued, that's what it indicates. So it's the right way forward, basically.
Okay, and finally, since you tracked this space for long, what about stocks like HPCL and BPCL, which are beginning to make a fresh move, yeah?
Now, that's completely out of syllabus, and I don't think even disclosures have been made. But at the cost of making disclosures, I don't own those stocks anyway. But sorry, what was your question again?
On oil marketing companies, Jal.
Right. So the oil marketing companies are also quoting at very compelling valuations. Unfortunately, the cycle has been one which is, as you know, refining margins have been dismal. Essentially, diesel crack spreads, which is the largest product, and we're in the region of $10 to $15, are barely about $4 and a bit now increasing. So unlike most other commodities, this sector is recovering slowly. And because oil is a global cartel in the form of OPEC, oil has been increasing very sharply, and therefore there's a cost push from the refining business. So these company profits are slower to increase there. Also, as oil increases sharply, they are smoothing the impact on the consumer and increasing their retail prices relatively slowly. So eventually they do make a healthy amount of money within any given year. But from the perspective at the moment, the margins tend to be subdued. Otherwise, I think it's an option time to be buying into these stocks. I mean, we are positive, but unlike some of the other commodities, if you're expecting a V-shaped recovery in margins, I wouldn't expect that in this industry.
Okay, Jal, we'll leave it there today. Thanks a lot for joining us. Always appreciate talking to you. We need to take a break.